Triggered partly by uncertainty due to the effect of quantitative easing in Europe and concerns over Greece's worsening negotiations with its international creditors, cash remains a safe haven for fund managers, as over the past month bond and stock markets have witnessed some of the biggest swings in years. Wealth manager Jonathan Davis doesn't think these latest developments are anything new.
There's always risk. As to the signs that they're seeing of increasing risk, I'm not convinced of that myself, because when I look at, for example, the index of the potential volatility in the S&P 500, your listeners will know it as the VIX. I see the VIX at still essentially all-time lows, or there or thereabouts. So there is no hard and fast indication that there is any particular increased risk in markets. It's a fact that markets aren't performing as strongly as they were in 2013 and 2014, but that of itself does not necessarily state that risk is coming.
Daniel Jakubowski is a vice president at portfolio manager Senegon. He thinks that while Greece has become more of an issue, it's been front of mind for some time.
When we definitely one key event, you certainly would be Greece these days. Some people say more so than ever. Others say it's been around for 5 years now. So let's say maybe the attention. Greece tends to draw more attention now and then sometimes less. But certainly I would say that it seems to be coming more and more to a peak there. So obviously, I would definitely agree that there's probably more uncertainty than let's say a year ago.
Daniel says cash is often not the best option, even in times of volatility.
As far as we are concerned, we're not too big a fans of cash allocation in our funds, because we find that it's rather a cyclical reaction to what's happening, because obviously you got to sell assets to generate cash, and then once you think stress is out the market, you'll have to rebuy assets. So you're very much you're very much bound to the timing of that sell and buy. So what we're preferring as a solution would be to hedge portfolios using put options. If we talk about equity portfolios, that's what we do. We stay fully invested, but we're also fully hedged with put option positions.
If investors are able to put money into markets that are at record lows, there may be some scope for significant return. Jonathan Davis thinks Greece looks attractive in the long term.
The Greek stock market is down 90 to 95% on 15 years ago. And if I may quote Baron Rothschild from the 19th century, buy when there's blood on the streets, metaphorically, I hasten to say. And when I see a market in a Western democracy which is down to 5 or 10 pence in the pound, then I am very interested. And when I look at the potential in the Greek banking system, I know it's shot to pieces. That's the point. No one wants it. We've dipped our toe into Greece, and as things resolve there, or apparently, we're very likely to double, treble, or quadruple our long-term investments in Greece. In fact, it's the most exciting investment opportunity in the world today for the medium to long term, as far as we're concerned.
The ECB's quantitative easing programme has caused further uncertainty in the market. However, Daniel thinks that the effects have been predicted so far.
If the ECB is heavily buying into sovereign bonds, then what else is going to happen but prices of those rise and yields fall? So I think that was definitely expected. The magnitude of course is always up for discussion whether or not that could have been anticipated, that German bonds would almost go to zero yield, or that Euro stocks or whichever European benchmark in equities rises a little over 20%. But I would say that direction could have been anticipated. Magnitude, obviously, always a little more difficult.
Jonathan doesn't think QE is helping the flight to cash.
Stock markets benefit from QE. Currencies often are detrimentally affected by QEs, but there is no particular statistical significance to that because often they can benefit from QE. I'm totally unconvinced by the idea that QE, which apparently is about buying government bonds, actually pushes up the price of government bonds. Because, for example, if you look at QE 1, 2, and 3 of the United States, when they have had QE, government bond yields have risen. When they ended QE, government bond yields plummeted, as indeed they did in 2014 as they ended QE. So, no, I would say on so many counts, QE is an abject, utter failure, and it's also bad economics, although it's probably good politics.
Cash does, however, remain a certain market, which Jonathan concedes may be attractive to some.
Give me a market which is certain, and you're talking about cash. Anything else, there is no certainty.
Earlier this month, European Central Bank President Mario Draghi said markets should get used to volatility, something that many strategists said could have exacerbated the migration into cash. Despite many fund managers not being happy about it, high cash reserves could become the new normal.